Dear ladies and gentlemen, my name is Eszter Szentes, and I am working as a senior tax advisor and global mobility tax expert at VGD Hungary, which is a member of Nexia International. In this video, I will introduce you to the most relevant personal income tax and social security requirement in Hungary for Chinese private persons and employees. As a technical information, if you do not see the subtitles, please set it in the right corner of the screen. Firstly, I will introduce our company to you. VGD is an owner-managed medium-scale consultancy company that was established in 2001 and has been working for more than 20 years on the market. We have services in different fields. We work in the fields of accounting, auditing, taxation, and payroll. We have more than 50 employees with professional skills and many years of specialized experience. We are working with more than 300 international and domestic clients in several sectors like Bosch, Boji, Fujifilm, Unicredit, SK battery manufacturing, and so on. We can offer several services to you like audit, accounting and payroll, transaction services, tax advisory, transfer pricing, VAT and fiscal representation, digitization solutions and IT consultancy, CFO services, startup and legal seat services. Our colleagues can provide you with comprehensive professional assistance in these areas. I will talk briefly about the following topics. First of all, the tax residency rules, then the personal income tax rules in Hungary, the income types, the social security rules and risks, and last but not least, the permanent establishment risks. Tax residency. Tax resident private individuals shall be subject to tax liability in respect of all their income. It means unlimited tax liability. The tax liability of non-resident private individuals shall apply to income that originates in Hungary as the place of gainful activity or is taxable in Hungary by the provisions of international agreement or reciprocity. It means limited tax liability. To determine the taxation liabilities, not only the domestic provisions, but the provisions of the double tax treaty concluded between the affected two countries should also be examined regarding questions in the area of international taxation. First of all, tax residency is the most significant fact that should be determined. It depends on the tax residency of individuals and companies, which country has the right to tax their incomes. In order to determine the tax residency of the private individual, several factors should be taken into consideration. For example, permanent residence, center of vital interest, usual place of residence, and nationality. Permanent residence means the place where the private individual is registered as a place of residence. Center of vital interest means the place of the most important personal, economic, and family ties of the private individual. Usual place of residence means where the private individual is staying more than 183 days in a year. In the case of private individuals from China, with which Hungary has concluded double tax treaty, the provisions of the treaty are considered decisive if the involved private individual is qualified as a resident private individual based on the domestic rules of both countries. After the determination of the tax residency, the regulation of the double tax treaty should be applied for the identification of which country is entitled to the taxation of the specified income. In our case, tax residency based on the double tax treaty concluded between Hungary and China should be determined. It should be examined. Please note the official tax residency is determined by the tax authorities in the countries concerned. Therefore, our opinion on the tax residency is based on the provisions of the double tax treaty between Hungary and China with the application of the available information. Personal income tax in Hungary. There are many situations when a non-resident person should pay personal income tax in Hungary. For example, Hungarian-sourced employment income or income for sale or rental of real estate. A 15% flat rate is the personal income tax in Hungary. The same rate for employment income, dividend, interest, and rental income. The personal income tax advance should be calculated and paid quarterly and should be declared in the yearly personal income tax return in the case of a foreign private person. The personal income tax returns deadline is the 20th May of the following year. For example, in case of 2023 income, the 20th of May 2024. Income types in Hungary. As I already mentioned, there are many situations when a non-resident person should pay personal income tax in Hungary. Firstly, employment income. If the employee spent more than 183 days in any 12 months in Hungary, the employment income will be taxable in Hungary. We should mention the economic employer concept as well. Hungary implemented this rule, and in the case of assignment, the term employer should be considered in a broader sense, and the whole context of the employment should be reviewed to determine which entity is the economic employer of the employee under a provision of the treaty, and to be able to decide whether exemption under Article 15 can be granted to avoid host country taxation. It means if the individual spends less than 183 days and is paid by a foreign company, first of all, an integration test must be performed to identify which country is the economic employer. Integration in this sense means which company is responsible and bears the risk for the result of the employee's activity. Second option, managing director. If a Chinese managing director is working for a Hungarian-based branch office or commercial representation and personally contributes to the company's activities, then taxation must be examined. The personal income tax possibly will be taxable in Hungary, payable in Hungary. The social security liabilities should be examined as well. Third option, the dividend. A 10% withholding tax is payable in Hungary in the case of Hungarian source dividends according to the agreement between China and Hungary. Fourth option, in case of income related to real estate, becomes taxable in the country where the real estate is located. Therefore, if a Chinese person sells or rents real estate in Hungary, it will be taxable in Hungary. Social security. There is no social security agreement between China and Hungary. Therefore, in light of these circumstances, it must be examined whether a Hungarian social security obligation arises or not. To determine the necessity of the social security payment, the following background information is important: permanent residence, period of stay in Hungary, legal relationship in Hungary, for example, employment or executive legal relationship, paying companies tax residency. The social security payment can be determined after having this background informations. And last but not least, the permanent establishment risk. The permanent establishment risk is important both for the companies and for the employees who are working in Hungary. From 1st of January 2021, the permanent establishment rules have been tightened in two respects. On one hand, the provision of services by an employee for more than 183 days, even without a physical permanent establishment, triggers a permanent establishment in Hungary for a foreign taxpayer. In addition, the related projects should be taken into account on an aggregated basis. On the other hand, in cases where a particular double taxation convention allocates a permanent establishment to Hungary in certain circumstances, but no permanent establishment would arise under the Hungarian Corporate Income Tax Act. Permanent establishment should be allocated to Hungary under the double taxation convention. The circumstances should be examined from the person establishment risk point of view as well, in the case of assignments or Hungarian employment as well. I hope you enjoyed my video. If you have any questions or concerns, you can reach us on the following contact details. Goodbye.